Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode number 247, Earning Interest on Your Cash with Connor Hanlon, CFA. All right, Connor, welcome back to the show.
Thanks for having me, Corey.
Happy to have you here. Happy to be talking about earning more interest on cash, which is exactly what we're going to get into today. This is something that's been really relevant for virtually everyone, I would imagine, that watches or listens to this show. But I am Corey Bittner. I'm subbing in, pinch hitting here for Jake Falcon, as Jake and Rachel are traveling and taking a well-deserved vacation. So we're excited for them. So Connor, the portfolio manager on our team at Falcon Wealth Advisors, has joined me here today. And Connor, I think you're becoming more of a familiar face for people that watch the show. You've really we've ramped it up some. We've had you on more often. Hopefully it's been a good experience for you.
Yeah, I'm enjoying being a recurring guest.
Very good. Well, we're happy to have you here. But before we get into today's show, Connor, anything new and exciting going on in your life? What's been going on since the last time you were here?
Nothing too crazy, just continuing to chase my almost 2-year-old daughter around, which is a full-time job.
I bet. Yeah, I'd imagine when she's fully mobile is when you guys are in a little bit of trouble. You got your hands full.
Exactly.
Yeah, that's good. That's good. That's exciting. I'm at my standing desk here today, which is good. I'm continuing to recover from this injury that I had, my torn calf. But it's good that I'm standing now, have weight on it. I'm walking more like a normal person. Look forward to hopefully getting back on the courts later this summer. But let's go ahead and just get into today's show. And as a quick reminder for the audience watching or listening at home or out and about, make sure you subscribe to the show. Give us a 5-star rating, a thumbs up if you, of course, think that it is worthy of it. That helps other people find the show. Our intention is to educate. It's not to provide specific advice for anyone. We ultimately want to provide education, give people food for thought and considerations for, really what they should be evaluating in their financial plan. And we've been pleased to see the subscriber count continue to grow. But as far as today's show goes, we're going to jump right in. Connor, we have talked with more and more clients over the last 12 to 18 months about maximizing the interest that they're earning on their cash. So we're not talking really about investing as far as the big picture goes, or thinking about a diversified portfolio or the markets. We're talking about how to earn more interest on the idle cash, the money that's in the checking, savings, money market fund, whatever it might be. So just to kind of set the table for that, Connor, just to get us kicked off here, can you talk about how much interest rates have increased in the last year or so?
Yes, and I'll start with kind of the benchmark rate that most of the markets use, and that's the Fed funds rate. And so when we look at a year ago, last May, the upper bound on the Fed funds rate was about 1%, and the lower bound was about 0.75%. So just under 1% right there is kind of the benchmark rate. Now the upper bound is 5.25, lower bound is 5%. So pretty significant move from a year ago on that benchmark rate.
Yep, absolutely. Which has a number of consequences, right? Positive and negative across the markets. It's certainly created ripple effects. Anyone who's had money invested for the last year and a half, has certainly felt that, I know. The upshot to it all, though, is what we're talking about today, right? People can earn more interest. For savers that haven't been able to earn much interest for a long time, that's changed because we've seen rates move up so meaningfully over the last few months and the last year or so. And that's really why this opportunity has presented itself and why we're talking about this. I've joked, Connor, with clients, and you very well might be in the same boat. I've joked with clients that I've been waiting for higher interest rates my whole career. Because that's all that I've ever heard is that interest rates have nowhere to go but up. And we've continued to see them decline really over the last decade or so. That's obviously changed. We are in a different environment now, and that's what we're highlighting today. So I appreciate you setting the table there, Connor, to kind of explain how much the Fed funds rate, which is what banks lend money to each other at overnight, but it's kind of the basis for a lot of decisions that banks will make. One of the questions I have for you, Connor, is one that I've gotten from a lot of clients lately, which is, why don't banks increase the interest rate that they pay when interest rates are increased when the Fed raises rates? Why don't banks increase the rate that they pay on deposits?
Well, that'd be great if they did, but the main reason there is because that's how they make money. They make money on the spread between what they're, paying you for keeping your money there at the bank and what they can lend money out and get an interest rate or invest it themselves in other bonds or interest rate products in the market.
Yeah, so I think it sounds like the cost of money is one of the reasons, right? If it costs the bank more money, to bring deposits in, the reality is the more interest that they pay out, that erodes profit margins. So that's one of the reasons. And I think beyond that is, you kind of highlighted this, Connor, but the lending and the investment considerations around that, I think that's important and helpful for people to understand. I have some notes that I made here. But because banks generate a significant portion of their income through lending and through investments, when rates rise, as borrowing costs increase, which could reduce loan demand. That's another component I think that's at play. So banks might have existing loans or investments, which is what we've seen play out here in the last few months, with fixed interest rates that don't benefit from a rise in rates. So all of that can influence the choice that a bank makes around how much interest it pays on its deposits. So I think it's helpful for people to understand that just because rates are higher doesn't mean the cash that is in your savings or checking or money market account is earning more interest. That really comes down to the individual institution. So given that's where things stand, we've talked, Connor, on this show, people that are tuned into the market have heard the Federal Reserve talk about the likelihood that they may be pausing their interest rate increases. They may move rates a little bit higher, but largely speaking, I think a lot of the increases are behind us, just listening to what the Fed has told us. But from your perspective, Connor, what is the expectation for interest rates from this point forward?
Yes, so we're still seeing a pretty big difference in opinion from the Federal Open Market Committee, the Federal Reserve, and the market in general, based on where Fed fund futures are trading. So the market, I'll call it as a whole, thinks that there could be rate cuts as soon as September. I personally think that's a little soon for that to actually happen. But on the other hand, the Fed will tell you that they're not planning on any rate cuts anytime this year. But it is, I would say, agreed upon by both the Fed and the market that we're going to at least pause here for a while and let the data catch up, see what the effects are.
Makes sense. So while there is, the market and the Fed are at odds in some ways around that, that really brings us to the crux of the show, Connor. So what can, regardless of what interest rates do from here, we know where they're at right now. What can people do to take advantage of this higher interest rate environment to really maximize their savings and maximize the interest that they're earning on their cash?
Yes, they can buy. One way to do it is buy Treasury securities. We talked about where that Fed funds rate is now versus last year. And that's a short-term rate. That's an overnight rate. So what that does is it affects a lot of the short-term treasuries, from 1 month out to about 2 years. We're seeing these elevated yields where you can buy a treasury. It's a historically very safe investment and earn really attractive yields up to 4 or 5%.
Can you just define at a real high level, Connor, what a treasury bond is?
Yes, it is backed by the full faith and credit of the United States government. And you're loaning the government money, essentially. They're paying you an interest rate. Is really what it boils down to.
Okay, so from a safety or security standpoint, whether somebody has money in a savings account or someone buys treasury bonds with that cash, what's the difference as far as security goes?
Yes, so in a bank, the number one securitization or line of defense would be the bank and the bank's assets. But of course, some of those assets up to $250,000 are guaranteed by the government with FDIC insurance. So pretty similar in that regard when you're comparing money in a bank account and treasury bond.
Yeah, that makes good sense. And I think, there's a lot of people that have asked questions about treasuries, about CDs, whether that's CDs that they can buy on the open market, or CDs that, the bank or the credit union down the street might be offering. And even high yield savings accounts. We've talked to more clients about that, as well as ways to earn more interest. But I think the bigger theme here for anybody who's watching and listening is that the environment has changed. It's much more competitive now, and that banks are competing for deposits. And there's also ways that people can earn more interest by buying treasury bonds that are backed by the full faith and credit of the government. Exactly to your point, Connor, somebody buys a CD, it's ultimately backed by the FDIC, which is backed by the government. Right. So with all of that being said, given the fact that rates are much higher now, what kind of investments are we buying for clients, Connor, at Falcon Wealth Advisors? And what do you think people should really be considering around the cash that they're sitting on?
Yes, so we are, like we've been talking about, with kind of that short-term bucket of cash. If investors have cash, they may need for a tax payment next year, they may need for a down payment on a house. We're putting that cash to work in the meantime at these attractive short-term rates. So that's what we're doing on the short-term side. And just when thinking about the total bond allocation, these rates are historically attractive when we're looking back at, say, the last 5 years. So we're locking in these rates. We're taking the opportunity to lock in these rates, not just for short term, but for a 5-year term, a 10-year term, just to make sure that we're taking advantage of these as they're available.
Yep, very good. So when we're laddering the fixed income or the bond positions for clients, we're not keeping it too narrowly focused on the short term, because that can bring up reinvestment risk, right, Connor, where we're reinvesting money at lower rates in the event that rates decline over the next several years. But really, we're highlighting today very, very short term. When you talk about treasury bonds, we're talking about bonds that mature in a month, 3 months, 6 months, money that's sitting in the savings account, whatever it may be, because those rates are much more attractive. Connor, as of this recording, a 3-month treasury bond is yielding about what?
Above 5%.
Yeah, which again, a few years ago, that was what, 0.1%, something in that ballpark. So those rates are much higher. So this is a good time for people to, review and adjust and evaluate what it is that they're doing, because that's the environment. And I think, frankly, that, there's some expectation that people have that, deposit rates, interest rates that they'll earn on their cash is going to follow what rates have done more broadly speaking, but which may or may not happen. We're going to get into that a little bit more here in a moment. But I think a theme of this show, Jake and I talk about this when we record this regularly, is that there's no decisions that are made in a vacuum and that are made, in perpetuity. So I think, frankly, that reviewing and adjusting the approach that you're taking is something to do. That's a good way to take advantage of a higher interest rate environment. But I think it's helpful to evaluate what's the right choice today, and then to monitor and make adjustments along the way, because it could change, right? If interest rates do end up declining in the next 6 to 12 months, that will change the situation, that will change the outlook. And that is a good time to have a conversation with your fiduciary advisor about the interest that you're earning on your cash.
Absolutely, Corey. And you mentioned, not putting all your eggs in one basket with these short-term rates and the reinvestment risk there. So we are continuing to ladder just so that we are not taking too much risk on one specific interest rate environment.
Good. I appreciate that, Connor. Are there any risks or drawbacks for people that are, I'll say, chasing higher interest rates?
Yes, I would say there are, and some of that can go into why are these interest rates high, right? Because then we can start getting into, there may be credit issues. Companies that have a little bit riskier of a balance sheet are going to be trading at much higher yields. So really what I like to say is you can't just go to Schwab or TD Ameritrade and Fidelity and sort by yield when you're looking to buy a bond.
Sure. Yeah, that will ultimately yield everything all over the place, as you and I both know, right, Connor. But yeah, I think that's helpful for people to understand and for people to know. So I do want to just take all of this information and just ask you this question though, Connor. If I had $50,000 or $100,000 that's sitting in a bank account that's earning very little interest, what should I consider doing with that cash? But I know that I might need it. I know that it's the rainy day fund. Maybe the cash is already allocated for something. But what should I be looking at specifically? What should my takeaway and my actionable item to be? What should that be given where rates are at now?
Sure. And like you mentioned, that 3-month treasury bill is over 5% right now. So even if you did know that, hey, I'm taking a big trip, or I'm putting a down payment on a house, or I'm going to be buying a car 3 months from now, well, you can still put your money to work for that 3 months and get that 5% annualized yield on
Yep.
on U.S. Treasuries.
Yep, that's really good. Now's the time to take a look at it. Evaluate the bank accounts, evaluate the cash, evaluate the interest that you're earning, and have a conversation with Connor, with myself, with us at Falcon Wealth Advisors about the right path forward for you to make sure that you are maximizing interest in the environment that we find ourselves in now. So, Connor, from your point of view, what are just some common misconceptions or myths, I should say, about interest rates that our audience should be aware of?
One of them that comes to mind for me is that a bond, depending on its term, a shorter term bond will pay less interest than a longer term bond, right? That's conventionally, that makes sense, right? You're locking your money up for longer, so you think you should get a higher interest rate. But as we've seen for the last year or so, that's not always the case. Right now, we have an inverted yield curve, which is something I've talked about on the show before, to where treasuries are actually paying higher yields in these short-term maturities than they are in, say, the 5 or 10 year.
Yeah, so I think that it is a myth or a misconception, right? That the longer you tie up the money, the more interest you're going to earn. I suppose we could say, Connor, that in a normal functioning market, that is what the expectation would be. But the yield curve inversion that you've mentioned is certainly not the first time that we've seen this. It's something that we've seen before. It's something that we've seen over many times over the years, frankly. So that is the unique opportunity here. But we really can't stress enough the point that we don't want to be so short-sighted that any and every dollar that we have invested in bonds for clients is maturing in a year or 2 years, because we need to be mindful of that reinvestment risk. However, good time to evaluate everything and understand, though, that longer doesn't always mean more interest. The same way that I think, Connor, that the presumption that lower interest rates are always a good thing for a borrower, or higher interest rates are always a good thing for a saver. There's really, the always never statements we always have to be careful with, because there's a lot of different influencing factors on that. But I think that those are misconceptions that people have, because it's just not really the case. And I think the other misconception that I have experienced is, assuming that interest rates will remain constant. I think it's human nature that we have the expectation when things are going in a certain direction that they'll continue going in that direction, whether it's upward or downward. But as we know, over the last few years, we've seen things sort of whipsaw all over the place as far as interest rates go. We've seen them up, we've seen them down, we've seen them up, we've seen them down again. So just assuming that interest rates are going to remain constant, I think, Connor, you've really provided some insight here today that while rates are where they're at, I mean, you spoke quite literally about the way that the markets are pricing expectations for future interest rates versus what the policymakers that set future interest rates are saying, right? They're at odds with each other. The point there being that things are subject to change. They can fluctuate over time. You want to be mindful of the interest rates that you're locking in, but you also want to be mindful of your time horizon.
Absolutely. And yeah, what we've talked about today is really just, like you said, taking advantage of an opportunity.
Yeah, that we haven't seen in a long time. Absolutely. Connor, do you have any real life examples or success stories that you can share from any client conversations you've had recently around ways we've been able to take advantage of this?
Yes, I do. I spoke with a client the other day who is working on a construction project. They're going to be having to pay kind of installments as that construction makes progress over the next 6 to 12 months. And what we did is we said, okay, here's this cash we know is going to be going out the door, right, on these construction payments. But while we have it here, let's set up a scheduled maturity ladder to have, okay, we've got 50,000 maturing this month. That's going to be going to get that construction payment, 50,000 the next month, 50,000 the next month. So rather than just letting that sit in cash, earning nothing, we're putting that money to work.
Yep, that's great. That makes perfect sense. I had a conversation with a client within the last week or so that had $100,000 to $150,000 in cash spread out across multiple bank accounts, all of which were paying 0.01 maybe to up, around 0.5%. But either way, interest rates that are meaningfully lower than what we're talking about here today. Because the institutions where the money's parked, they haven't raised the rates on their deposits. And whether that's, expected complacency, or that people, won't make changes to where their deposits sit in light of this environment, perhaps that's the reason that the bank would do that. But either way, this is an example of somebody that we were able to go and buy exactly like we're talking about here, Connor, treasury bonds that are paying around 5% to earn a lot more interest on that cash than they would otherwise, with it just sitting in the bank earning nothing. And I can even speak to this personally. I make quarterly tax payments. So what I've done is when I set cash aside that's going to ultimately get paid by the way of tax, can go and buy treasury bonds that mature in a month or two to earn some interest on that while I ultimately wait to write the checks.
Why wouldn't you?
Exactly. If the interest is there, I want to make sure that I'm optimizing. Even if the money's going to go out the door in a few months, I'd rather earn more interest on those dollars between now and then. Okay, good. What else, Connor? Any other parting thoughts or any other wisdom that you would want to bestow upon our audience here today?
I think we've covered everything.
Okay, very good. Well, I think the big takeaway for everyone here is that if you have questions around this, or if you want to understand what's the right path forward for you, reach out to me, reach out to Connor, reach out to our team at Falcon Wealth Advisors. We can all help and evaluate from a fiduciary standpoint what the right step is for you. And I think that's a crucial component in all of this, is that make sure that you're working with a fiduciary advisor who ultimately is going to make a recommendation that's based upon your best interests. That's the relationship that we have with clients at Falcon Wealth Advisors. But I really think for people, this is a good opportunity to evaluate and adjust what the approach is to money that's been sitting in the bank, maybe for the last 5 to 10 years, where it just hasn't really mattered that much because we haven't seen interest rates vary much. There hasn't been, nearly as much volatility around rates. I think that this is probably something that largely people just haven't paid too much attention to for the last several years, but now they're paying a lot more attention. This is a good time to reevaluate that.
Yeah, I agree, Corey. And yes, it really hasn't mattered for a little while, and now it does. So why not take this opportunity to reevaluate and lock in some of these attractive rates?
Exactly. And as all of the clients at Falcon Wealth Advisors know, while we build out financial plans and each client has a specific individual target rate of return, the more interest that we can earn on idle cash, on bonds, and the fixed income side of the portfolio, the less heavy lifting the equity side of the portfolio has to, the less heavy lifting has to occur in order for somebody to hit their target. So that's really why we talk about this, why it's important to make sure that you're taking advantage of maximizing the interest that you can earn, because ultimately that's what can help your short-term and long-term big picture financial plan.
It all adds up.
Yes, that's absolutely right. And I do think, Connor, that is about all the time that we do have here for today. Again, appreciate you coming on to the show. Anybody has any questions, of course, feel free to reach directly out. My email address is Corey at Falcon Wealth Advisors, at CORY, or Connor at Falcon Wealth Advisors, and we're happy to talk with you. But I appreciate your time here, Connor. Thank you for everybody who is tuned in, watching, and listening at home. We will look forward to talking to you next week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.